You can end up paying thousands more in taxes every year just because of how and when you take money out of your IRA. This is something that blindsides a lot of retirees from a tax perspective, and they're called required minimum distributions, or RMDs. These are mandatory withdrawals from tax-deferred retirement accounts like IRAs and 401ks. And under current law, RMDs must begin at age 73 if you're born between age 1951 and 1959, and age 75 if you're born in 1960 or later. That change came from the Secure Act 2.0, which passed in 2022. Now, if you're already taking RMDs, you're probably familiar with the basics. So the amount that you have to withdraw is based on your account balance as of December 31st, the previous year, and it's calculated using IRS Uniform Lifetime Table, which factors in your life expectancy. In this video, I'm going to walk you through 3 powerful strategies and 1 major exception to help you manage or even reduce your RMDs. First, how taking money out of your IRA before you're required to can actually save you on taxes. Second, how to use Roth conversions the smart way. And third, a giving strategy that lets you avoid taxes and support the causes that you care about at the same time. Plus, I'll share 1 major exception that might let you skip RMDs altogether if you're still working. My name is Zach Morris, and I'm the founder of Paces Ferry Wealth Advisors. I'm a certified financial planner, and we help people plan for retirement every single day. Let's talk about 1 strategy that's hiding in plain sight, but often underused: taking money out of your IRA early. There's growing research and practical tax modeling that shows that taking IRA withdrawals before RMD age can lead to a better long-term tax outcome for some people, especially if you believe that taxes are going up in the future. You can start penalty-free withdrawals from your IRA after age 59 and a half. So if you're in a relatively low tax bracket now, you might benefit from taking some small intentional distributions every year. That can reduce your future RMD and smooth out your taxable income over time. Let's walk through a quick example. Say you want to spend $100,000 a year in retirement. Maybe part of that comes from Social Security, part from your spouse's Social Security, some from your taxable accounts, and the rest from your retirement accounts. At age 73, RMDs begin, and here's the issue. Once your RMDs hit, you could end up with more taxable income than you actually need to live, which pushes you into a higher tax bracket and potentially increases the taxability of your Social Security, depending what your total income is. That's why it may be smart to take distributions from your IRA earlier than required to manage your tax bracket and avoid surprises down the road. Another strategy to consider is Roth conversions. Now, why convert to a Roth instead of just withdrawing the money from your IRA? If you don't need the money to live on right now, Roth conversions can move money from your traditional IRA into your Roth IRA, where future growth is tax-free. You'll pay taxes on the amount you convert, but once it's in the Roth, there's no RMDs, and withdrawals in retirement are tax-free. So let's take a look at a quick illustration of how this might work. So the couple I'm going to review with you has basic living expense goals of $100,000 a year in retirement. Their health care for Medicare is going to come in around $10,000 a year for the both of them. They also want to travel at around $10,000 a year. And then they've got 3 kids. So they want to give each kid $5,000 each year around the holidays. So these are all of their major goals. And the assets that they have is $2 million in an IRA and about $650,000 in a joint taxable account. So if we were to look at what their goals are, so here's the line with their goals, right? And then this is all of their sources of income in retirement. So this blue line right here is Social Security, and the green line is required minimum distributions. So this is important because if you look at their goals, their sources of income are going to outpace their goals eventually, right? So all of this required minimum distribution that goes over that orange line is money that they don't need. So it's money that they're going to pay taxes on that they don't necessarily need to pay taxes on in retirement. So how can we mitigate that? So we're assuming this couple is going to start taking their Social Security at age 70 so that they can keep their overall income lower in order to do some Roth conversions. So one of the spouses is going to turn 71st in 2028, and then the other spouse is going to turn 70 in 2029. But that gives them 3 years of being able to do Roth conversions and be able to stay under a certain tax bracket. So let's see what all of this means from a tax perspective, right? They have more income than they need to live, so they're going to have to pay additional taxes. And for the most part of their life, they're in the 22% tax bracket. Some of their life, their income is going to be in the 24% tax bracket. Now, what if we did Roth conversions in those earlier years? Now, you can see the big part of what's dictating their tax bracket is their Social Security, which is this blue line, and their RMDs. And in this first year, their RMD is $109,187. So if we were to do Roth conversions through the 24% tax bracket up to the 32% tax bracket, but not going over, that means that they would convert $400,000 the first year, $374,000 the second year, and roughly $300,000 the third year, right? But that first year of required minimum distributions would be cut in half. So it would go from around $100,000 to $56,000, and it would continue to stay much lower than it was before. So the total tax savings, the total estimated tax savings of this strategy is going to be $362,000. Now, if we flip back to this total income view, you can see that the required minimum distributions are no longer pushing them way over what they actually need to live. Remember, this orange line is their goals, and these bar charts are what their sources of income are. So Social Security and required minimum distributions. Now they're not paying a whole lot of additional taxes that they don't really need to pay because they did those Roth conversions earlier on. Now, here's the trade-off and something to take into consideration, because to do a Roth conversion, you typically want to pay the taxes out of your taxable account. That way you maximize the amount that goes into the Roth. So here's a quick example. If you were to do a $100,000 Roth conversion and withhold 15% taxes from that conversion, then you're only going to get $85,000 into the Roth. However, if you were to do that same $100,000 Roth conversion, and then you were to pay that 15% out of a taxable account, then you're able to convert the entire $100,000 into a Roth, and with a similar effect on your overall tax bracket, assuming that the $15,000 that you paid in taxes was sitting in cash or something that didn't have a whole lot of gains or tax implications in order to generate that cash. So this is important to consider, because if your taxable account is small compared to your IRA, this can quickly deplete it and reduce your flexibility later on. So what I mean by that is that if you use all of your taxable money to pay the taxes on those Roth conversions, and you aren't able to convert enough to really fund your total retirement, well, then your only other source of income and of funds is by pulling more out of your IRA than you otherwise might have done. So going back to that earlier strategy, sometimes it makes sense to simply just take early withdrawals out of your IRA. Now, not early in terms of before 59 and a half, because then you have to pay a penalty, but early in terms of prior to the age of required minimum distributions, depending on your date of birth. So you might be saying to yourself, wow, this is a great strategy. I'm already taking RMDs. Can't I just use my Roth conversion and count it toward an RMD? And the answer is no. Not only can you not count your conversion toward your RMD, but starting in 2025, there's a new rule that says you actually have to take your full RMD prior to doing any kind of Roth conversions. So if you've already started taking RMDs, what's another strategy you can use to lower your overall RMD, especially if you don't need the money? One way to manage the tax impact is through what's called Qualified Charitable Distributions, or also referred to as QCDs. So a QCD allows you to give up to $108,000 per year, and that's the 2025 limit, so it's indexed for inflation, directly from your IRA to a qualified 501c3 charity, and it satisfies your RMD without counting as taxable income. So let's take a look at how this works. So the same sample client that we talked about before has a required minimum distributions if they do nothing at age 73 of $109,000. So let's see what the tax impact would be if they were to give half of their RMD to charity every year for 15 years. So their RMD, at least for the first 15 years, would get cut in half from $109,000 to around $54,000. And it would save them, so the estimated lifetime tax savings is estimated to be around $391,000. Now, it's worth noting that if you're not charitable, you don't want to just give the money to charity, right? You might as well just pay the taxes, put it into an account. Maybe it's more important that you leave an inheritance, right? So if that's the case, you don't want to just give it to charity in order to avoid the taxes. So, however, if you are charitable, there are ways to give QCDs that can be very effective and really fit into your overall lifestyle. So if you give $500 every Sunday at church or your place of worship, then you can actually get a checkbook from your custodian. So Charles Schwab, Fidelity are two of the biggest custodians. I know Charles Schwab can give you a checkbook, and you can actually write a check out of your IRA. So it's important that you keep track of everything, because the custodian is going to report this distribution on your 1099-R, and that's going to be the same as if you were to take a distribution. But you provide the information to your CPA, or you put it in TurboTax, and you keep records of it in case you were to ever get audited, so that you can prove that that distribution went to a qualified charitable organization or a 501c3 organization. It's worth noting that you cannot use a QCD to fund a donor advised fund. And if you'd like to learn more about donor advised funds, we have a video that covers the topic at length. But you can send the check directly to the charity. It's also worth noting that you don't have to itemize deductions in order to have QCDs work for you. So they're even more valuable because of that. So if you're giving $5,000 a year to charity and you're not currently getting a deduction because you don't itemize your deductions, because remember, if your itemized deductions don't outweigh the standard deduction, then you just take the standard deduction, right? So if you get $5,000 and you give it out of your QCD, you give a QCD, then you don't have to realize that income. And so you get a benefit for that charitable gift where otherwise you wouldn't have gotten a benefit from it if you don't itemize your deductions. Now, one last strategy for avoiding RMDs altogether, at least for a while, if you're still working and contributing to a retirement plan through your current employer, and you don't own more than 5% of the company, you may be able to delay RMDs from that employer's retirement plan until you retire. So that rule only applies to the current employer's plan and not IRAs or previous 401ks. And it can get tricky if you're working for a family business or a company you partially own. So definitely talk with your CPA if this applies to you. Now, in some cases, if you still have IRAs or 401ks outside of your current employer and you're still working after the age of 73, you could do what's called a reverse rollover. So again, with any tax strategies, make sure you check with your CPA. But a reverse rollover is essentially taking your IRA and rolling it into your current employer's 401k. And just like taking a previous employer's 401k and rolling it into your current employer's 401k. So if you're working and you qualify for this exemption from RMDs, that may be a way to avoid RMDs from your other accounts as well. I hope this video gave you some useful ideas. Again, my name is Zach Morris, and I'm the founder of Paces Ferry Wealth Advisors. If you found it helpful, please go ahead and hit the subscribe button and the notification bell so you don't miss future videos. Thanks for watching.